as more people are jumping on. But we have a very special guest today. I'm looking forward to sharing with everybody. If you've been following us for a while, you've no doubt heard of Marshall Reddick, but you've maybe even heard of our guest because we've had him on as a speaker before. And he's going to share some really cool stuff about building wealth through real estate and private lending. And the company is Marshall Reddick Real Estate. And I don't want to steal too much thunder, but they do a few different things at a very high level: real estate sales, property management, and private lending. And they have grown a lot since I was first exposed to them in the mid-2000s. But personally, I purchased real estate through the organization, rental properties, and both my dad and I have been affiliated with Marshall Reddick for many years, and they've been a partner of ours for a long time. And Dimitri, the owner and founder of SenseFinancial, has been affiliated with Marshall Reddick, to say the least, for a lot of years as well, since about the mid-2000s, maybe even the early 2000s. So we've known each other for a long time, invested together, and there's a level of trust here. As with any webinar, this is educational only. We are not giving financial advice. We are not telling you or anybody else what to invest in, just sharing options with you. Do your own due diligence. And I'm going to get started here in a moment, but as we go, please use the chat to ask questions. We'll definitely give time for Q&A, and I'll monitor the chat while our guest is speaking. If there's a relevant topic to that particular slide, I'll just interrupt and we'll address it right then and there. Otherwise, we will give time at the end for sure for actual Q&A. So without further ado, my name's Brett. I'm a self-directed IRA solo 401k consultant here at Sense Financial, and we are a boutique financial firm that specializes in retirement accounts with checkbook control. We've been in business for about 16 years, and we have 5-star reviews all over the place. Feel free to check us out. And we've helped a little over 7,000 clients set up over 8,000 different types of self-directed retirement accounts. And most of our clients come from referrals. These referrals mostly come from existing clients, but we have great partnerships with different companies who offer investment opportunities like Marshall Reddick, and a lot of the referrals come from them as well. So we appreciate that. And some of the just high-level benefits of an IRA that's self-directed or a solo 401k are the ability to have what we call true diversification. I'm not actually sure how you would define it any other way, because the IRS since 1974 has allowed people to invest in non-Wall Street assets like real estate, crypto, precious metals, private lending, etc. And inside of a retirement account, the returns are either tax-free in a Roth or they're tax-deferred in a traditional. And the reason it's truly diversified is because if you have an IRA like a lot of us do, or a 401k at an employer, you know that you can pick from any stock, bond, mutual fund, or ETF that they might offer. But there's a whole world out there of alternative assets that can control at least more of the outcome, and can better predict what the return is going to be. So that's what self-directing is all about. It's not about an either or, it's about an and. Keep some money in the stock market or go into real estate completely. It's totally up to you. That's the beauty of self-directing. You can leverage your funds with non-recourse financing. We'll talk about that in a little bit, because Marshall Reddick is actually a provider of non-recourse loans. And then our plans have what's called checkbook control, where you have the ability to invest the money yourself and not go through anybody else, not go through Sense Financial, through a custodian, through anybody. You quite literally control the money inside of a checking account. You can write a check, do a wire transfer, ACH, online bill pay, etc., to make the investments and get the returns back into the plan. And the solo 401k, if you're self-employed, you should take a look at it. It is a true tax shelter. We call it the ultimate retirement plan because it allows you to contribute so much, and it has Roth and traditional built in. I could go on and on. That's not what we're here for, though. Just know that the solo 401k is a very powerful tool for the self-employed to save for retirement. I talked about the unlimited investment options, but the true diversification is all about not putting all your eggs in one basket and having the risk that if the stock market goes down, you could be diversified into different types of businesses or asset classes, so to speak. But you're not going to be truly diversified until you unlock your retirement account to invest in alternative assets like real estate or private lending, which our guest is here to talk about. And that person is Vince Tomic, and I am going to introduce him. He's going to work on getting his screen share started here in a moment. Vince began investing in real estate in 2016 and owns multiple rental properties, providing him with firsthand experience as an investor. He previously spent 4 years as a residential mortgage lender, building a strong foundation in financing and transaction strategy. As a realtor and advisor with Marshall Reddick for the past 7 years, Vince assists clients with acquisitions, dispositions, property management strategy, and private lending opportunities. His lending background and personal investing experience allow him to deliver practical, strategic guidance aligned with each client's long-term goals. And let's see, Vince, did we lose you? Might have had some technical issues here. Let me see. There he is. Going to get that screen share started in just a moment and let him take over. And he's going to share more about what Marshall Reddick offers.
Thanks, Brad. Sorry, we just had a little tech issue where let me get my share screen up. Give me 1 second.
No worries. Hey, I also got it as a backup if we have any hiccups, so I'll get that ready in case.
Oh, no worries. We're pulling it up now. Let's see. Can everybody see my screen?
Yeah, it's coming through.
All right, we're gonna go to presentation mode. 1 second. Cool. You got me?
Yeah, it's a little. The resolution is a little bit not great, but go for it. It should clean up.
Okay. Yeah, and let me know. Stop me or let me know if you're having issues hearing me or seeing. And yeah, feel free to jump in. But do really appreciate the intro. We were fortunate enough to have Brett at our office yesterday, and Brett was giving us in our team the rundown on self-directed retirement accounts and just the power that comes with using and leveraging those resources. And he put it so well that Sense Financial basically is able to create the vehicle, and then with that vehicle we leave it to the investors to decide what they want to invest in. And we want to be one of those investment providers, right? So when you have that vehicle set up to be able to determine what types of investments, and we have a few that we'll go over today that I think are really great fits for self-directed and for those individuals who are not necessarily only interested in investments in their self-directed retirement account. We, of course, offer these as personal investments as well. As Brett mentioned, my name is Vince Tomic. I'm an advisor and realtor here at Marshall Reddick. I have been with the company now for coming up on 7 years. I can remember one of my very first presentations was with Sense Financial, and it was, we were hosting them on one of our platforms. And I remember so much value coming from, Dimitri and Brett as it pertains to those self-directed retirement accounts. And I think it was shortly after I heard that presentation, I signed up. So I'm a personal client of Sense Financial. They have helped me with multiple investments. I've purchased property in my solo. I've invested in notes. I'm a partner in our mortgage fund, stocks, bonds, etc. So it's been an incredible partnership and personal, basically, development by learning and exploring through their resources as well. As Brett mentioned, I practice what I preach, getting involved in real estate and lending and doing all the things that we do. So in addition to, of course, being an employee, I also speak from a client standpoint as well. So happy to field any questions or scenarios that you might be working through, because maybe myself or another client has worked through those same exact ones.
Hey, Vince,
for those of you that are...
Let me, sorry, I'm going to interrupt you. Just because the slides are somewhat blurry. So if it's okay with you, okay, I'll share my screen and then you just say next when you want me to change the slides. Is that okay?
That totally works.
Yeah, let me just get my screen share started here. I think that'll look a little cleaner for the audience. Should be able to see
no problem.
That. There you go. Okay.
I can see that. Cool. Okay. So for those of you that are unfamiliar with Marshall Reddick Real Estate, I always like to take a minute just to explain who we are and what we do. So I like to consider Marshall Reddick as a full service real estate firm. And we basically have 4 services that we focus on. So our real estate brokerage, our property management, we're a private money lender, and we also have investment funds. So for real estate brokerage, right, we help people buy and sell, whether it's here in Southern California, which is where I'm located, or in one of our out-of-state markets, that being Texas, Tennessee, and Florida. 99% of the folks that end up buying one of those investment properties, they are going to need property management support. So we offer property management services as well. Anything from rent collection, rent disbursement, and repair requests, all of your tax filing documentation at the end of the year, basically everything from A to Z. We would handle that on your behalf. And we have boots on the ground resources to handle all that, which is a huge step. It's really, in my opinion, the mechanism that allows you to scale, right? Which is having that support in-house and local. And then third is we are a private money lender. We're going to talk a little bit about that today. Some of the examples of people that borrow money from us that would seek Marshall Reddick out for lending are going to be your fix and flippers, your individuals like you folks who have self-directed retirement accounts. You would need a non-recourse loan to acquire property. That's what we can offer. And then there's also other individuals that use short-term kind of bridge financing. Again, these are all specific scenarios of which people would reach out to Marshall Reddick. And it's not typically going to be connected or individuals that would get a conventional loan. We're not in competition with conventional loans, and we're not taking on borrowers who don't qualify. Just to be clear, it's definitely more specific borrowing objectives. And then lastly, we have our mortgage fund. So our mortgage fund is instead of being the borrower, you are actually a lender. So you're lending your capital. So the way I like to describe this is instead of buying property and collecting rent checks, you as a lender you lend your capital and collect mortgage payments. The nice thing about being on the lending side of the business, there's no maintenance, there's no vacancy. You don't have tenants that you are, constantly dealing with. So it's a little bit of a different side of the business. There's pros and cons, and we're going to go into some of those.
If I go the right direction, right? There we go.
There you go. Perfect. So as I mentioned, I am in our Newport Beach office, but you can see here on the map, you will see these are where all of our, where we have a physical footprint where we handle management services, brokerage, etc. So again, I just like to use this illustration for those of you to get familiar, or maybe thinking about markets that you've been interested in. Maybe you have property in, maybe you just have some, things that, that are worth discussing in these various markets. This is a helpful illustration for that. So things that we're going to cover today: how should I identify a good investment market? Should I focus on cash flow or appreciation? What types of investments are people targeting in 2026? We're going to talk about some Marshall Reddick financing options that basically we're exclusively offering for the Sense Financial folks. Really, it's going to be for self-directed retirement account people. And then how to analyze investment property, how to generate cash flow through private lending, right? So I wanted to offer the opportunity for those that might be interested on the lending side of the business is how to take advantage of that. And then go over some of our mortgage fund basics, again, in case that's a home of interest to any of you folks. Okay, so how do I identify a good investment market? You can go next on this one, Brett. Okay, so here are some of the key criteria that we put together as, this is what we focus on when we're identifying these markets. One, we want to make sure there's population growth. So we want to make sure people are moving to that city, moving to that state, and there's an uptrend to those numbers. I think that's really important. And that's kind of one of our basic elements as when we're exploring the markets, or how we arrived at the markets that we're in. Because I think everybody can agree, not every market across the country is a good market to invest in. So population growth, number one. Two is we like to focus on job growth. We want to make sure there's a good pool of jobs and make sure that when you have tenants there, they have somewhere to go to work so that they can generate income to pay that rent, right? And that leads me to economic diversity in targeting markets that aren't, solely focused on one industry. The concern, right, is if that industry goes away or there's a shift, then you have a lot of people that are unemployed, and that creates problems, of course. So having that job diversity is really, really important. Housing affordability is also key, right? I think, all of these metrics can make sense here in, in some parts of here in California, but housing affordability is a big problem right here. So that's what pushes a lot of folks that may be living here to invest in some of our out-of-state markets. Is much more affordable pricing, much more attractive, especially from an investment standpoint. And then landlord friendly. Not to keep picking on California, but those of you that are invest here are probably very familiar with some of the tenant, landlord and tenant rules, and how certain states favor more of the tenant side and certain states favor more of the landlord. So we are exclusively focusing on states besides California that are focusing on, landlord friendly states. I think that's really important, especially for those that are scaling their real estate portfolios, to have that, in their back pocket. And then good infrastructure. We want to make sure that, that we're not in a market that can't, that doesn't have good highways and hospitals and schools, et cetera, right? Those are all important support features of a market that I think really make or break, the investment in the long run. So those are some of the key criteria we seek out, and that's how we've established our headquarters or our offices in those various markets that I outlined earlier. Okay, this is a question I get all the time. Should I focus on cash flow or appreciation? And we'll go to the next slide and I can break that down for you a little bit more. We have this really awesome ebook on our website. It's free for those of you to join if you wanted to take a look at it. It's the Marshall Reddick Property Rating ebook, and basically what it tells us is, we have this colorful chart here, which starts with luxury and it goes all the way to D class. So what you'll see here is, as you tend to go towards the side of luxury, you'll see those properties, how they perform is typically they're going to appreciate more, right? They're going to be at a higher price. You're going to typically get a higher quality tenant, and therefore you're usually in a neighborhood that's trading at a higher dollar value. So therefore, those prices will continue to go up and up and up, over time. And then as you kind of slide down that scale, B, C, D, you're going to start to focus on properties that have more cash flow. They're going to be lower purchase price properties. Maybe the tenant quality is one that's not going to ever really be a buyer. It'll be, a renter forever. And that's kind of what that neighborhood or that community looks like. And there's reason to kind of go after each one of those depending on, your goals and strategy. I would tell you though, as a whole, the company is really more focused on A, B class properties. We seldomly get into C class properties and don't get into D class properties. The reason for that too is what you'll see below is as you slide up and down the scale, anybody who's owned property before can attest, you will have maintenance and you will have vacancy. Someone that tells you that you won't have those things is probably has not owned property long enough, but you will have those things. And it's impossible to forecast at the beginning of the year exactly what those variable expenses will be. So we do our best to make estimates based on the property class. So what you'll see below is kind of a sectional of A, B, and C class properties and our allocations for maintenance and vacancy. So as you see below, you'll see A class properties with 8% maintenance, 8% vacancy, B 10 and 10, and C 13 and 13. You'll see how as you go more into the C and D class properties that those expected variable expenses tick up. Now that's something to note where sometimes people who are seeking more cash flow don't factor in what those variable expenses could be and ultimately chase cash flow on day one, and sometimes doesn't work out that way. Just this is a helpful chart, and the way I like to think about it is A class equals appreciation and C class equals cash flow. And you can kind of split the difference, right? And go after some B class properties that kind of touch on both. Okay. Now, what types of property should investors target in 2026? So this is something that I think is even a trend from last year, right? So right now what we're seeing is in a lot of markets, there's a lot more inventory. One of the types of property that we've been targeting is new construction. Now, why would we go after new construction? There's a lot of benefits to that, but I'll go over them. I have some bullet points here. Of course, there's warranties. It's brand new, so there's not going to be any deferred maintenance. Everything, has a sticker on it. It's brand new. There's typically higher tenant demand, right? Tenants as well as owners, everybody likes new and nice and clean, right? Having that component or having that for an investment property is usually more attractive to a tenant. There is a lot of supply, which is a good thing, and I'll kind of dovetail into why that's a good thing. And then there's builder financing incentives. So because builders are feeling the pressure of all the things we talked about, the supply of there being quite a bit of options, builders realize that the product is not moving as fast as it once did, and they have to do something about it. And what we're able to do is take advantage of some of those builder incentives, whether that's negotiation on purchase price, whether that's closing cost concessions, whether that's, appliances, blinds, fridges, all the things inside. Or what we've seen be the most impactful is builders are offering these significant credits to help buy down the interest rates. And what that really does is that allows the cash flow numbers and the numbers to really benefit you as an investor by really kind of altering the financing, because right now financing is still one of our biggest headwinds. We are seeing an improvement in rates slowly. We're seeing that, and it's still a developing story, right? We don't have a super clear path as to when we're going to see more improvements, but we have seen a slow trajectory downward, which is great. But right now, builders are still definitely eager to get sales done. So those incentives are still on the table. I'll go over some examples. We have been able to formulate some interesting Marshall Reddick provided scenarios for specifically only for the self-directed folks, but I also just included, another option outside of a self-directed retirement account, and I included those numbers to review as well. So we can go on to the next slide and kind of dive into some of those. Speaking of, so Marshall Reddick, as I mentioned, is typically going to be on short-term financing, fix and flip loans, um, you know, shorter 12-month is kind of the term. Because of the relationship we had with Sense Financial, I had a conversation with our director of private lending, and we were able to extend slightly longer terms, 3 and 5 year interest only terms for those that might be seeking to buy property and use non-recourse financing. You don't have to use the non-recourse financing with us if you wanted to buy property with us from our brokerage side and use our property management, but found non-recourse financing elsewhere, it's no problem. We just, being that we had the opportunity to host this webinar, we did want to actually provide some scenario or some solution. So what we're doing here in this scenario is we're targeting we're targeting properties that come with let's call it a hefty builder concession. So in my next slide, which we won't go to just yet, there is a significant builder concession that we're buying down this interest rate. So this rate typically for a 5 year term is 7.95. So to get this down to 6.25 is really helpful. And the exact loan amount is going to depend, or sorry, the exact rate is going to depend on the loan amount. So for those of you that might be interested in taking advantage of something like this will be more of a one-on-one conversation to figure out property type, down payment, etc. But I did want to let everybody know that we do have something set up. Okay, so how do I accurately analyze investment properties? And on our next slide, what we're going to do is we're going to go over a couple of our pro forma just really quickly. We'll kind of go through line by line so that you can see how we break this down on our website. Again, this information is free on our website. You can see this if you go to invest properties and you can click, whatever property you want to see this kind of format. So we can look at that next, Brett. Okay, so here's one of our first properties. Now, this one is what I would call our special financing or our in-house Marshall Reddick financing. So this one looks a little different because I had to create this spreadsheet on the side here. Normally it looks slightly different, which you'll see on the next slide. But this is a new construction property in Clarksville. I actually just helped a family member buy something very similar to this. These are single family homes. You'll see all the specs here: 3 bed, 2 bath, 10,000 plus square foot lot, almost 1,500 square feet. The list price there is $337,900. So in this scenario, we have a down payment of 50%. Now, I'm using that because specifically, I'm trying to get the rates and the numbers to work as best as their ability. If you're looking for higher leverage, we can totally explore that and go through that. But I just wanted to show like kind of an easy, clean example of how this can work as you have a larger down payment. So for some of you that have a significant amount of capital in your retirement accounts, it may behoove you to put more money down, especially if the rates are higher, right? So that's kind of what my logic was with this scenario. But then you'll see line by line, we factor in closing costs, your total investment capital of 175,708, and then we go through all of our income and expenses. So our gross rent, $1,850. The nice thing about these, we are getting these rented within a couple weeks. Like I said, I had a family member when we went into escrow, we started marketing the property. He actually was able to have a tenant in prior to close. I can't say that can be the case for every single person, but I can tell you that I've seen it firsthand and I've seen it recently, right, over the last few weeks. In this scenario, for all of our Marshall Reddick private financing, it's interest only. That was, if you go back one more, Brett, I'm going to spend a little time on this one and then I'll kind of breeze through that one a little faster. This is 6.25 interest rate. You have your taxes, insurance, management fee, HOA. So your fixed monthly expenses at $1,368. And then we do factor in maintenance and vacancy, and then you'll see those cash flow numbers below. So I like to focus more on fixed expenses because that's truly what you're going to be getting minus your expenses every month. Of course, the variables are going to come in month by month, but you're looking at about a $480 cash flow per month, or when you factor in that 8% maintenance and vacancy, about $133. And then you have your, return on investment after 5-year hold, because this is assuming a 5-year balloon payment. Now, this next property, this is actually a 3-unit, and this is in one of our suburbs of Dallas. Now, something to note here, this is not part of our Marshall Reddick financing. This would be through one of our conventional lenders or our conventional lender, CNG Financial Hazard. So Reed has been able to buy down these interest rates much more aggressively. So in this scenario, this rate is 4.75. You'll see that right under gross rent. And then this property also comes with free management for 12 months. So this is like a perfect example of what I was describing. This is a builder who's definitely interested in moving this product. So what they're going to do is they're going to offer a lot more incentives, that being the interest rate, that being the free property management. And you'll see, I'll just kind of skip right to it, but you'll see the monthly cash flow in this scenario is around 1,500 per month, right? And then when you back out all of your variable expenses, that comes down a bit, but at least you're able to see in year one, right? Now, once year two comes into play, you'll have your management fee that kicks in. So, I would say that's another 500 a month. You'll be able to, let's call it almost $1,000 of cash flow, which is pretty great. So we can, again, for those of you that are interested in any specific deal, we can go into more detail, but I guess I wanted you guys to at least see what our format looks like, and that these are available to research on our website at any time. Okay. Just really quick kind of plug about property management. At the end of the day, we want to make sure we offer that service to you guys, because we do feel like without having that support after closing, it becomes really difficult, or sometimes just not doable. So I just wanted to discuss what we do. So I consider us full service, from marketing the property, a tenant placement, rent collection, rent disbursement, any kind of maintenance stuff. We kind of touched on this in the very beginning, but it is soup to nuts. Experience that we can provide. And then all of the financial reporting, you have an online portal. You can track, with the rent, the management fee, any kind of expenses. This is all logged month over month. So there's really great tracking. And of course, for your year-end documentation, we're going into tax season now. So for those of you that are kind of struggling with that, we definitely have all of those expenses outlined for you. And then, of course, compliance and legal oversight. Ultimately, our job is enforce the lease. We want to adhere to local regulations. And truth be told, we just need to keep you out of court. Like, that is the end goal here, is like, make sure we enforce the lease and that we are the intermediary between you and the tenant. You will never have any interaction with them. It will always be us communicating, and therefore really kind of has that separation there. Okay, to switch gears a little bit, I talked about kind of the offerings that we're doing exclusively for our Sense Financial folks with some of our private lending or non-recourse options. But I did want to touch on the more common borrowers, the people that make up the bulk of our kind of business. So we'll go into kind of what, Marshall Reddick Private Lending does and what we focus on. Okay, so basically, we are exclusively focused on non-owner occupied properties, most of the time short term. I know that 3 to 5 in a lot of people's minds is short term, but when we say short term, we're thinking like 12 months or less. First lien only. So we don't have any seconds or any juniors. And then we do have conservative loan to value. So we really have an in-house underwriting team that focuses on exactly the LTVs that we're comfortable with, making those approvals or denials based on those guidelines. This is the design for your real estate investor. So the people that are trying to submit offers quickly, get a deal, and to quickly move through their project so they can either turn around, refinance the property, or sell it. Those are typically your two exits. We're trying to keep up with that pace and generate that partnership, because truth be told, there's not as many private lenders that fill this void. So there's definitely longer term relationships that we've established, that we've had for 10 plus years, that have been really good return clients. And that's something that we want to keep and foster. And then it's all secured by residential real estate. We're mainly focusing on single family homes. We will venture into that 1 to 4 unit space, but we don't get into any commercial. We're not in office space. We're not really doing anything outside of that. And the reason for that is our whole organization is surrounded by that residential kind of theme. So we feel very confident in any kind of disposition, management, maintenance, anything related to that. We do that in our normal day-to-day business. So we feel like lending on assets like that give us a great resume to support if there's any kind of a default or situation where we have to take the property back. That's not our intention going into any loan, but we have done that in the past, and we will protect our capital partners, and we have the resources to make sure we can do that. So, how do you generate cash flow through private lending? So, kind of switching gears here, right? So, in the beginning of the call, we were talking more about buying real estate and those real estate offerings that could be in any of our various markets. And now I'm switching it a little bit because, in my opinion, I feel like self directed retirement accounts are such a great home for lending. Right, lending your capital via those vehicles, I think, is an amazing avenue. I have a solo 401k, and I have been investing in our mortgage fund through that solo 401k. And, I think that to me is, I'll get into some of the specifics as why I think that's so important, or why I think that's so valuable. But I think this alternative is really great for those of you that might be not as comfortable with actually owning and operating and dealing with real estate, especially with retirement funds. This is a lot more, the lending side of the business is a lot more, I guess, predictable. So for those reasons, it's definitely grown a lot of popularity. So we'll go into how you can actually get involved. So there's two ways that Marshall Reddick offers investors the opportunity to lend their capital. There's direct lending, and then there's the mortgage fund. I'll give you examples. So direct lending would be an example: one borrower, one lender, right? I need 100,000. You have 100,000. Marshall Reddick puts us together. I make my payments to you month over month. Your name, and it would be your LLC, your trust, it doesn't have to be your personal name, but your entity would be the lender. You would be on the loan docs. It's one borrower, one lender. Usually those are a little bit larger loan amounts. You have a lot more autonomy as a direct lender. You can pick and choose what loan you would like to fund and what looks better based on yield, based on market, based on scope of work, whatever metrics you use that are important to you. You have that autonomy, but it's more active too. Our borrowers are typically folks that are in the short-term world. They really only have to hold the loan for 3 months. After 3 months, they can pay that loan off anytime. So oftentimes those that are really qualified or really experienced people who renovate homes, they're paying those loans off faster. So you get your interest and capital back faster, which is great. But now you have all that money again and you have to redeploy. So it's more active in that standpoint, that you have to keep looking for the next opportunity. For the mortgage fund, this is above and beyond the more popular path. And I think for a couple of reasons you'll see here, there's diversified risk. If one borrower were to have problems or there would be a default, our loan now is up to 80 million. You would not even notice that kind of an issue in an $80 million fund. If you were the sole lender and that borrower has some kind of difficulties, you of course will be made aware of that and you will be more involved. There's a smaller barrier to entry, our mortgage fund, and I'll go over some of the basics, but it's a $25,000 minimum investment. There is a bit more flexible terms in terms of like how long you want to keep the capital, assuming that you at least keep it for the first 12 months. After that, there's much more of a flexibility there. And then, like I said, the funds can work in perpetuity and it's a lot more passive. In my opinion, one of the big benefits, especially in the self-directed world, is you can take our quarterly distributions and you can reinvest those. Oftentimes, when you have payouts, whether it's rent or any kind of distribution or dividend that funnels back into a self-directed retirement account, you're starting to accumulate this smaller amount of capital that it's probably not enough, or not usually enough, to do another separate investment with, but it is just sitting there in cash. So you do have some cash drag. So I think what the fund accomplishes is long-term investing and keeps all of the money working, and you start to get compound interest. So I think those are really great avenues to leverage when you're using self-directed funds. And you can go to the next slide, Brad. I think what we're going to talk about more specifically, some of the basics I touched on in the fund. So again, the fund is a pooled investment. It's not one borrower and one lender. It's me, you, and 300 other capital partners that accumulate up to 80 million. And now the fund and the fund manager is responsible for originating and funding the various loans across the country. So that risk now is spread all across the 50 states. We're not actually in all 50, but we are across the country as opposed to one project. Some of the bullet points here: $25,000 minimum, as I mentioned. There's a 12-month minimum hold. After 12 months, you can call for the money back at any time. You can invest more capital or withdraw capital as needed. So that's kind of touches on that flexibility. You always have to keep that $25,000 minimum position, but as far as adding or taking away, that's totally fine. And then we have a 6% preferred return plus a capital account based profit split. So what that means is usually most of our, especially as you get into the fund, you're at a 50-50 profit share split. So after we pay our preferred return, what's left over is profit. 50% of that is to the investor, 50% of that is to Marshall Reddick. And we've been yielding about 8.5% since inception. The fund just turned 6 years old yesterday. So that's the origination of the fund. Now, we've been doing private lending for 10 plus years. It's just how we offer it to our investors. Instead of we were only offering direct loans for the last 10 plus years, the fund now has had a home for the last 6 years. And you can take that distribution in the form of cash. Like, for example, I reinvest all of my proceeds, so you can reinvest it. But my dad, on the other hand, he will take his distributions every quarter, right? So different, kind of goals for different people. And the only limiting factor is you do have to be an accredited investor. I'm sure a lot of you folks on the call are familiar with that term. If not, I can go into that detail. And then we do provide a K1 at the end of the year, which ultimately, if you are investing in a self-directed, not as crucial, not as important piece of documentation as it would be if you invest in your own personal name, which you can. Okay, so just to kind of touch on the current performance, like I said, the fund is about up to about 80 million, and our annualized return since March of 2020. So, like I said, just hit our 6 year mark for that 50-50 profit share split. We've been yielding about 8.5%. Now, that's assuming you reinvest your distributions. So there is a bit of a compound interest component to that calculation. I always like to tell people to expect around that 8% per year. So that's 8 to 8.5 is kind of how we get into that range, depending on if you're reinvesting or not. And you'll see there's an increased profit share tier as you go up in capital. So 500 and below, about 8.5, 500 to 3 million, just under 9. And then 3 million and above, you're almost at that 9.5 figure, assuming you've been in for the whole 6 years reinvesting. Now, with that, those differences, what I wanted to point out is, you can, I have a lot of people that start with just kind of entry level, whether it's 25, 50, 100, and they can work their way into this. So you can become more comfortable to eventually grow to that position. You can also change whether I want to reinvest my distributions, and then maybe next year I want to start taking my distributions. So we do offer a lot of flexibility there. And then as far as just most recent data in Q4, we did 71 loans, just over 23 million. Our average loan amount was 330,000, and our weighted interest rate was just 10.43%. So the way that the fund is generating revenue is of course, by interest payments, but of course, also charging origination fees. So being part of that fund, share in both, and that's how we're able to, help boost that yield up for our capital partners. Okay, so as I always like to point this out for anybody on webinars. We do provide a ton of free education. You can find this on our website, marshallreddick.com /learn. So anybody that wants to revisit maybe some of our quarterly distribution calls on our mortgage fund, or maybe an investment presentation in one of our various investment markets, we do offer a lot of those recordings. They're on our website for free to you to join. There's books, there's guides, there's articles. So feel free to explore and try to get any questions you have answered. Of course, I'm also going to provide my contact on the next slide. I'm happy to set up calls or to be able to field any questions for specific scenarios, whether it's, you have a self-directed, whether you just have your own, investment ideas, whether you just want to buy real estate in a family trust or in your own name, whatever it is, we can help. I definitely want to at least gear a lot of the conversations towards vehicles that could be taken advantage of with those self-directed retirement accounts, because I think they're such a great tool. And I'm really grateful to be a part of the presentation, and being the opportunity to speak to Brett and Dimitri's and Sense Financial's whole team here. And Yeah, thank you so much, Brett, for the time today.
Yeah, no problem. Appreciate you coming on. I am hoping people bring in some questions. I wrote down a couple that I'd like to ask. Maybe that'll
Yeah,
spur some interest here. But Sandra did ask one question early on, and maybe you can touch on it a little bit more. But she said, I am in Tennessee. What did Vince say about Tennessee? And I responded saying that Marshall Reddick has an office there. You obviously gave an example of a property in Clarksville, I believe it was. But anything else about Tennessee that you might add for a local resident?
yeah, absolutely. So somebody who's in Tennessee, we can help for any brokerage need, right? So whether it's buying a local property, we have an office in Clarksville and we service Nashville. So Tennessee is a big state. So I kind of wanted to firm up where we could be the most impactful. And that's going to be anywhere basically from Nashville to Clarksville and those general surrounding areas. So I hope that helps answer. But property management, brokerage, any of our services that we offer, we would offer it in Tennessee as well.
Perfect. When it comes to the new construction, I'm curious. Obviously, don't wait to invest, invest and wait is the general mantra of the wealthy. But outside of that, I'm curious on the new construction. So, with these builders, do they want to limit or do they limit a certain amount of owner occupied versus tenant occupied, or are they just willing to sell to whoever a buyer is? Is there any issue with that? Is there, like, if someone's looking at a certain community, is there a certain amount of inventory out of the 1,000 homes that are going to definitely sell to investors or could? And then after that, they cut it off and only do owner occupied, or is that really not a factor?
That's a great question. And the answer is it depends on the community. So for example, there's a community in Franklin that we're been promoting heavily. It's a town-owned community. There are some limitations in that specific community as to owner occupancy, right? But then there's larger communities across Texas and Tennessee where it's really first come, first serve. There's no limitations. I think where you really have to be careful, and this is, we don't really offer many condo opportunities for purchase because usually the HOA becomes too cumbersome for the numbers to work. The owner occupancy question that you have is very important in a condo association because there's oftentimes that once you have not enough owner occupants, you get into conventional financing dilemmas where maybe it becomes a non-warrantable condo and it's harder to get financing. You just have to go a different path, and that cuts off a good amount of buyers. So um, that's really, I think, where that question is the most kind of you have to be the most cautious, but it really is project dependent on owner occupancy and whether that's a limitation or not.
Gotcha. Good. Man, those interest rates are fantastic. I mean, we're not in post-COVID times where you're getting in the twos or threes anymore. But when you look at even owner-occupied conventional loans being in a lot of times in the high sixes, even sevens, depending on circumstances, to be able to get a 4.75 or even a 6.25 is amazing. I mean, those are great numbers, dude. I love it. People should jump on this
We we
for sure.
we actually have a community in right outside of Austin. It's called Buda, where the builder's actually offering 3.75. So it's really builder dependent, right? So what's going to happen is based on a builder's interest level to move a unit or not, that's their lever of which they kind of crank up or crank down to kind of determine sales and what they're willing to do. So you can see that, and that's why they're not kind of standard issue across the board is because it's all seller dependent. But for those of you that are interested in taking advantage of those, we call those that forward commitment financing. That's where the builder or the seller literally has to put that money up front to buy that rate down on the buyer's behalf. We're happy to only exclusively focus on opportunities like that if that's something that someone wanted to target.
Great. Okay, Gwen put a question in the chat. For direct lending, do you offer private money deals for specific locations? I think you said, kind of across the country, but you're not in all 50 states. Not that Marshall Reddick is against all 50 states, probably just hasn't expanded quite that extensively. But either way, she says, I'm located in the San Francisco area and at this time would only be interested in local private money. So the question is, would Marshall Reddick do a PML in the Bay Area?
Yes, we would. So we would. It's just again now in the Bay Area, right? The price points are a lot higher. The loan amounts are typically higher. So we would definitely do one. We actually have some pretty large projects happening at the end of this month, like in California. So we do. We would totally do that. And if you wanted to be a direct lender, I can show anybody who's interested, I can show you the mortgage marketplace where you can seek out direct lending opportunities that you can shop and kind of decide to fund or not. But again, those of you that might not be interested in trying to pick an individual loan, just know that the mortgage fund is kind of the first line of response to all of our loan inquiries, as the mortgage fund determines kind of what they will want to take on kind of first. So again, it's I think it just depends on kind of everybody's expectations. But for the client that you just mentioned, somebody who's specifically looking for like a California or a Bay Area loan, may be wiser to be shopping on the marketplace.
She's also asking, Gwen, is can you share a bit more about the expected returns for direct lending? And does the investor also share points with Marshall Reddick?
That's also a great question. The returns can go as high as 12% for direct loans, but there is no point sharing. That is the profit that Marshall Reddick makes in the direct lending space. So the mortgage fund shares both interest and points. And as a capital partner, you share in all of that. But in the direct lending space, Marshall Reddick collects the origination fees, and then the lender collects the interest, whether that be 9 to 12%, just depends on the specific deal. And that's typically loan to value driven.
Sounds good. What's the preferred loan to value on most of these loans?
Yeah. So, basically for any of our renovation loans, we will not go more than the max loan amount will not go higher than a 70% after renovation value or ARV. That's the max loan amount that we will do. But in addition to that, upon acquisition, we will require a certain down payment. So the lowest down payment on a renovation loan is 10%, and then it goes up to typically 25 or 30%, but we always cap it at that 70% of ARV. So we know that based on the comps in the area, when a project is complete, we will never have more than a 70% loan to value.
Yeah, makes sense. Great. Well, cool. Yeah, we really appreciate this partnership. As you can see here, those of you that
Of
are on
course.
live and then watching this recording later, Marshall Reddick is a very unique real estate company, brokerage, if you will, in the sense that they do offer all these services. It's a really cool place to kind of spend your time. Their website, they do host local events sometimes, depending on if they have an office in your area, but yeah, check out their website. They do great stuff, a lot of education, and as you can see, based on this talk, a lot of great offers for investors to consider. So, Vince, looks like there's no more questions coming in. So, we appreciate your time. Any last words you want to share with the audience?
No, I just wanted to again thank you so much for the opportunity, and let anybody know that I'm happy to field any kind of questions that you have or any interest in any of the things we touched on today. Sometimes things develop quickly, sometimes it takes a while. So happy to be a sounding board for any of your folks out there.
Absolutely. All right, man. Well, thank you so much. Thank you, everybody. Yep, appreciate it. Thanks, Gwen, for the kind words and the questions as well. All right, take care, everybody.
Thanks, guys.